Chapter 3 can be a difficult chapter and contains information on adjusting the accounts. It is highly recommended you review this chapter thoroughly, as many students find this material challenging. Let's compare accrual and cash basis accounting. Accrual basis accounting will be the main focus of this chapter. Accrual basis is required by generally accepted accounting principles. Under the accrual basis, revenues are recorded when they are earned, not necessarily when the company receives the cash. Look for the keywords "service is provided or performed" for service companies, or the words that indicate a company's product has been sold to result in a company earning and therefore recording revenue. Expenses are recorded or recognized when they are incurred or happen, not necessarily when the company pays cash for the expenses. In contrast, under the cash basis of accounting, the cash activity drives the recognition. Revenues are recorded when a company receives cash from its customers, and expenses are recorded when the company actually pays the cash for them. The cash basis is not in accordance with GAAP, or generally accepted accounting principles. Adjusting entries result in the financial statements reflecting correct amounts. Companies make these adjusting journal entries every time they prepare financial statements, whether that be every month, quarter, or year. Adjusting journal entries result in the revenue recognition principle, that is, revenue recorded when earned, and matching principle, matching expenses with related revenues, being followed. To help with determining which accounts are involved with adjusting entries, remember one of the accounts is either a debit to an expense account or a credit to a revenue account. Because we know that there are always at least two accounts affected by each transaction, the remaining account is either an asset or liability account. There are two main types of adjusting entries: deferrals and accruals. Deferrals can involve prepaid expenses. Prepaid expenses are recorded when companies pay for expenses in advance, or deferrals can involve unearned revenues. Unearned revenues have been recorded if a company has received cash before they have done anything to earn the cash. For example, airline companies have unearned revenues when they have collected payment from passengers before they have taken their flights. The other type of adjusting entry involves accruals. Accruals can include accrued revenues. If a company has provided its service or sold its product and cash has not yet been received, the revenue will need to be accrued or recorded. If a company has incurred an expense and has not paid cash for it yet, the company needs to accrue or record the expense so the financial statements will accurately reflect the expense in the correct period of time. The first type of deferral we will examine involves prepaid expenses, in which the cash payment has been made before the expense is recorded. Examples of these situations involve insurance or supplies that have been prepaid, as well as rent and fixed assets that have depreciation associated with them. The second type of deferral involves unearned revenues, where a company has received cash before the company has done anything to earn, therefore record the revenue. Property owners can have unearned rent. Airline companies record unearned revenue until passengers take their flights, and educational institutions such as Scottsdale Community College have unearned revenue when it collects payments from students before the semester begins. Other unearned revenue situations include magazine companies, as well as companies that collect customer deposits. Let's go through an example of an adjusting entry related to prepaid expenses. On January 1, Phoenix Consulting paid $12,000 for 12 months of insurance. The journal entry recorded on January 1 is not an adjusting entry. Remember, adjusting entries are prepared at the end of the accounting period, so we would expect a date at the end of the month. The word payment indicates one account is cash, and because the cash is decreasing, it will be the credit account. The other account involved in this transaction is the asset account prepaid insurance, because the company now has an asset, a full year's worth of insurance paid in advance. The journal entry, as we learned in Chapter 2, is to debit, therefore increase one asset account prepaid insurance, and credit, thereby decreasing another asset account cash. The journal entry is posted to the T accounts contained in the general ledger. The January 1 debit balance in prepaid insurance reflects that as of January 1, there are 12 months of insurance paid in advance. At January 31, an adjusting entry is needed because there is no longer 12 months worth of insurance prepaid, but only 11 months of insurance prepaid, February through December. Remember that adjusting entries either include an expense account or a revenue account. Because the month of January has passed, it is necessary to record 1 month's worth of insurance expense as a debit. 1 month of insurance expense is $1,000, calculated by dividing 12,000 by 12 months. The credit account is the prepaid insurance account. It is necessary to reduce the prepaid insurance account by 1 month, and assets decrease with credits. After posting the adjusting entry to the T accounts, we see the adjusted amount in prepaid insurance reflects $11,000, or the remaining 11 months of insurance paid in advance. The $11,000 debit balance is the adjusted balance. Another example of adjusting entries related to prepaid expenses involves buildings, equipment, and vehicles, commonly reported under the plant, property, and equipment asset category. Companies spread the cost of these assets over their estimated useful lives in a process involving depreciation. On January 1, Phoenix Consulting paid $24,000 for equipment with an estimated useful life of 20 years. The entry associated with this transaction is a debit or increase the asset account, which is equipment, and credit or decrease the asset account cash. The transaction is then posted to the T accounts. The adjusting entry related to the depreciation of the equipment involves 1 month of depreciation, or $100, calculated by dividing the cost of the equipment by 20 years and then by 12 months. The adjusting entry is a debit to depreciation expense and a credit not to the equipment account, but to the contra asset account accumulated depreciation. The adjusting entry is posted to the T accounts with the following results. As discussed in Chapter 2, assets have normal debit balances, but because it is a contra asset account, accumulated depreciation has a credit balance. Now let's look at adjusting entries related to unearned revenues. Unearned revenues are recorded when companies receive cash before the cash is earned. Phoenix Consulting records $24,000 of unearned revenue on January 1 because the cash represents a payment from the tenant, Arcadia High School, for 3 months' rent in advance, January through March. The entry on January 1, which is not an adjusting entry, is to debit or increase cash, and credit or increase the liability account unearned rent revenue. After posting the journal entry to the T accounts, we see that the January 1 balance in unearned rent revenue accurately reflects Phoenix Consulting's obligation or liability to provide the tenant, Arcadia High School, the building for 3 months. Don't confuse the fact that the tenant, Arcadia High School, would have recorded prepaid rent. We are recording the journal entry for the property owner, Phoenix Consulting. At January 31, 1 month has passed, and it is now necessary to prepare an adjusting entry to record the fact that Phoenix Consulting has now earned 1 month's worth of rent revenue. Their liability as of January 31 is now only for 2 months versus 3 months, so the liability account, unearned rent revenue, needs to be decreased. Liabilities decrease with debits, so unearned rent revenue is now debited. The rent revenue account is the credit account. 1 month's worth of rent is $8,000, calculated by dividing $24,000 by 3. After posting the adjusting entry, the January 31 adjusted balance in the unearned rent revenue reflects Phoenix Consulting's obligation to provide the building for 2 months, or $16,000 worth.